Good afternoon, everyone. Robert Rayburn here from Life Pro Asset Management. I hope that everyone's having a great week so far. As usual, if you have any questions, concerns, any needs whatsoever, feel free to call into our team at 888-543-3776, or you can reach me directly on my cell phone if you have questions regarding your portfolio at 858-354-5114. That's my direct mobile number. I'm more than happy to discuss the portfolio, individual stocks, thoughts on the market, etc. And would love to hear your thoughts on the market and things that are going on in your life. But without further ado, let's go ahead and get started. The bottom line here is that despite the rally in stock prices since the bottom in March, investor skepticism remains high. In fact, investor skepticism is downright bearish, and we're going to go through some of the positioning data to prove that. But when we see that type of behavior with institutional investors, we combine that with a rising supply of cheap money, otherwise known as financial liquidity, and we combine that with an improving fundamental backdrop for individual businesses. That is a perfect 1-2-3 elixir for rising asset prices in the future. We love that type of setup. We want everyone to be on the other side of the trade. That's where we really succeed in the long term, is to identify areas within the market where we see barely any investors that are really wanting to take exposure, investing there, understanding the best of breed companies that are in those areas, and then letting the money flow to us, pushing asset prices higher as money comes off the sidelines. So today, in today's report, we're going to go over liquidity, understanding how much money supply is rising at the pace that it's rising at. We're going to go over interest rates and overall investor sentiment and what that means for your portfolio. We're then going to look at investor positioning data both on the S&P 500 and the Nasdaq and what that's telling us about sentiment. People can say one thing, but what are they actually doing? What they're doing usually tells us a lot more than what they're saying. And then, of course, we want to go over why stock picking is just so critical right now. We hear a lot about passive index investing, but quite frankly, we do not want to provide our advisors, clients' money equally to both good and bad companies alike. We want to do the homework. We want to do the hard work that is required to identify those best of breed companies so that we're not providing your clients' money equally to both good and bad companies alike. We do not participate in investment socialism. In terms of performance year to date, so far in 2020, we are up 49.69% after fees. When we look at the S&P 500 over the same time period as of July 29, 2020, it's only up 0.86%. In other words, we've been able to outperform by 48.83%. When we stretch out that time period to January 1st, 2017 to today, what we see is our performance after fees is up 143.92% after fees versus 45.54% for the S&P 500. In other words, we've been able to deliver 98.38% outperformance versus the overall market. And the key going forward really is to make sure that for our existing clients and our new clients, that the portfolio is constantly positioned to deliver more and more returns in a risk-adjusted fashion. In other words, if we have individual investments that are fully valued, we'll move away from those and into other investments where there is more asset price appreciation potential. So we're constantly looking at the portfolios. We do a daily inventory check every morning at 5:30 a.m. to make sure that we could answer the question yes to when we say, would we buy this stock today at this price relative to its future earnings growth potential? And if the answer is yes, we keep it. If the answer is no, we move on and we introduce a new stock. But you'll notice that we haven't done a lot of trading in the last month and a half. And that's because we really like the way the portfolio is positioned. You know, effective investing is all about 90% watching, observing, making sure management teams are doing what they're supposed to do, and 10% taking action when there is cracks in the portfolio, solidifying those cracks by repositioning where our client portfolios are invested. Now, in terms of liquidity, the supply of cheap money continues to go parabolic. We need to move away from this idea that the stock market and the economy are tied at the hip. Please stop paying attention to economic data. Economic data is really effective if we're trying to understand where to position the portfolio within the stock market. So if housing data is really positive, maybe we want to position in housing stocks. But it doesn't really determine the overall direction of the stock market. In fact, the correlation between the stock market and the direction of the stock market and the economy is 0.07 when we go back 50, 60 years. In other words, there is no correlation. Where there is strong correlation is the correlation between liquidity and the direction of the stock market. When we're in an environment where interest rates are low, there is a rising supply of cheap money and low inflation, asset prices tend to grind higher. And that's what we see today, especially when we combine investor sentiment data, which remains downright bearish. And why does it remain bearish? One only has to flip on the news to see what the headlines are saying, which is talking about high unemployment, people foregoing their mortgage payments, COVID-19. You can name all the headlines that would make people scared, the election. And so there's just a number of endless factors that are driving that bearish sentiment. For us, since we're long stocks and since we are positive on stocks, we love this because that represents a deep supply of future buyers that eventually get dragged back into the market. In other words, we want to skate to where the puck is going, not skate to where the puck is today. The other thing that's really confirming the rally is overall stock market breadth. There are more advancers than decliners. We want to see that as part of a healthy stock market rally. Now, one may say, and rightfully so, that, hey, breadth was confirming the rally, and then look at the deep sell-off that we got in February and March. To be fair, it's the market's not going to be able to sniff out a pandemic. A pandemic is one of those events where you can't really model that out. But what you can model out is where a more traditional recession is on its way, where companies are not meeting their earnings expectations. And what we've seen is that more and more companies are beating earnings expectations. That recovery that really was centered around the technology sector in March is starting to broaden out to include the industrial sector, the healthcare sector. A lot of the consumer discretionary names are now being pulled along in the rally. So more and more stocks are participating in this rally, and that makes the rally more durable. And that's key if we're going to be long-term investors. The other thing is we constantly hear about how this rally is only about Google, Amazon, Apple, Facebook, those mega cap technology stocks. And that's simply not true. In fact, of the 5 mega cap stocks that are either near $1 trillion or over $1 trillion in market cap, our portfolios don't own one of them. And so when we look at, and the fact that we're up close to 50% should tell you there are other stocks out there that are rising in this current environment. And so the fact is that breadth is rising. It's increasing the overall durability of this rally, and that's a positive factor for future returns. In terms of investor positioning, it remains net short. It remains bearish, and that's positive if you're long stocks. There have been 3 other big periods where investors were net short, and that was during the European debt crisis, the bottom of the European debt crisis back in 2011 and 2012. And then, of course, in terms of the China growth scare and the oil price collapse in late 2015 and early 2016. That, again, was a sign early on that stocks were starting to bottom. We see the same thing happening today. Despite the recovery off the bottom in March of 2020 here, institutional investors, remain net short. And that is a positive factor in our overall risk work. So we want to see that. Those are investors that eventually have to cover their shorts and buy stock exposure to cover their shorts. So this is a deep supply of future buyers that can come back into the overall market. In fact, this period right now reminds us a lot of March of 2009. Deep skepticism as it related to the banks failing, the Federal Reserve wasn't doing enough, all these things, gold, price of gold will go to the moon. All these factors remind us a lot of 2009. And of course, we had a 10-year bull market after that. Same thing today. We have a lot of deep liquidity in the system. A lot of people are short the stock market. A lot of people are sitting in cash. That is an elixir for future stock price appreciation. Nasdaq positioning, very similar. We don't quite see net short positioning, albeit, but we do see very subdued positioning relative to the aggressive positioning we usually see in the Nasdaq. So we can see that skepticism has even leaked over into the Nasdaq, which is very technology heavy and biotech heavy. So the fact that we're seeing subdued positioning here as well tells us in particular that the leadership of this rally, technology and biotech stocks, that rally appears to be durable and long lasting at this point. Now, in terms of the election, we've gotten a lot of questions about the election, and quite frankly, ourselves here at the office, we discuss the election and how will it impact the stock market, how will it impact client portfolios, and how do we protect clients against a negative election event. Part of understanding whether event risk is priced into the market or whether it's not priced into the market is by looking at volatility. In other words, we look at something called the VIX. The VIX is simply a measurement of the demand for put options versus call options. And are people willing to pay more for puts, which protects you against falling asset prices, or are they paying more for calls, which pays you if asset prices go higher? When the VIX goes up, that means that people are demanding more and more portfolio insurance against the portfolio going down in price. What we see right now, in particular, when we look at what's called the VIX futures curve, in other words, we don't just look at the price today, but what's the futures market telling us about the price in and around the time of the election? So what we said was, let's look at how volatility is being priced in October, which is the last month that insurance would pay out before the election. We see here is there is a strong demand for portfolio insurance in October. So you may say, well, that tells us that indeed there is risk around the election. But for us, what this tells us is that it's actually that risk, that event risk, is known by the market and is being subsequently priced in by the market into overall asset prices. In other words, a risk, any sort of risk that is identified by the market and we see it coming and we can prepare for it, that usually doesn't actually hit asset prices too badly. It's the risk that we don't see coming. In other words, a great example would be coronavirus. In the month of February, we saw it in China, but no one really at that point priced in the fact that we're going to have a global pandemic with economic shutdowns where, GDP a month over month was falling 80%. That's a risk that you don't see coming. That's why asset prices got hit so sharply in the first 2 weeks of March. This time, though, we really do see a lot of risk being priced into the election, uncertainty priced into the election. So does that mean we should take our eye off the ball as it relates to the election? Of course not. But the message here is that it's known, it's being watched, and if we feel a need to reduce portfolio risk as a result of this, we'll definitely let everyone know. The other big thing that's been happening, has been a falling US dollar. Please don't let anyone tell you that a falling US dollar is bad. A falling US dollar is another form of financial stimulus. If you are a US manufacturer of any sort of widget, a falling US dollar is the best thing you can wish for because it makes US exports cheaper versus their international competitors. Over the last 3 or 4 years, the one thing even before COVID that has not been working for US businesses has been the rising US dollar. It has acted as a headwind as it's made US products more expensive relative to their international peers. We're now seeing that reverse, and we're seeing that early on as having a stimulant activity effect for U.S. manufacturing, which has been rising much more strongly than the U.S. services sector. So again, U.S. dollar going down is very good, and ultimately that should be a good thing for U.S. stocks. The other thing we always want to keep an eye on, we do this every week, is we want to make sure that the bond market, in other words, the credit market, is healing or remains healthy. We had this big shock event as related to the COVID shutdown, but what we've seen since then is that the Federal Reserve has succeeded in taking that systemic risk to the financial system out of the market. Overall investment grade credit spreads, in other words, credit risk, perceived credit risk, continues to decline. And the same thing is happening in the junk bond market. In other words, what we would not want to see happening is credit risk falling in the investment grade market while it's rising over in the junk bond market. The fact that junk bonds, the credit spreads related to junk bonds are continuing to come down tells us that the overall system is continuing to heal, not just for best of breed companies, but even for those companies that have a lot of cyclicality to their business models. So again, a very positive symptom. And of course, when it comes to active investing, we want to make sure that we're only focused on the areas of the market that are healthy. And this has been a great year to really exemplify or to really communicate the value of active investing. There's been a lot of winners in this stock market this year, but there's also been a lot of losers. And that's why the stock market's flat. You have half, less than half, 25% of the market that's doing well, while the rest of the market is not doing so well. And so for us, even before COVID, we said to ourselves, where will business be generated? Where will most of the growth be generated? And the answer to that for us was online on the internet. So not just technology companies, but companies that utilize technology to do business effectively. In other words, do we want to focus on a department store where 95% of their business is via foot traffic, or do we want to focus on a business that has a strong e-commerce platform that is generating business both because of foot traffic, but also most of the growth is coming from online? In other words, they're able to reach more and more audiences without investing in physical real estate and people that have to, employees in each of those individual stores. Those types of businesses tend to have higher margins, and they tend to be able to do well in different types of economic environments. And so you can see, we look at the change in retail sales this year, clothing and footwear stores, in malls, whether it's large malls or what we in terms of plazas, is down around 34%, versus those online store models are up 49%. So let me ask everyone on this call today, would you want to be invested equally both in online businesses with strong e-commerce platforms and businesses that are largely reliant on foot traffic? Well, the answer is probably no. You want to focus more of your money where the health is, where the growth is. And when you invest in a passive index, when you invest in an ETF, you're investing in all these businesses equally. And that just doesn't make any sense to us. It doesn't take a genius to look at this chart and really say, where is the durable long-term growth going to be? And so again, when we look at e-commerce penetration has really inflected higher, and we believe that the leaders being established through this period are going to command durable long-term leadership and growth for the next 3 to 5 years. So we want to take advantage of that as active investors. One quick thing on the economy. If there's been one area of the economy that's really come out of this, aside from e-commerce as a big winner, it's been housing. When we look at where interest rates are today, the 10 years sitting at around 0.58%, mortgage rates have really started to drop. They're in and around 2.8% for a 30-year fixed rate mortgage right now. And where we're seeing a definite V-shaped recovery is in pending home sales. This is the shape of pending home sales in the U.S. A deep drop-off in March for obvious reasons, but then a strong, relentless recovery back to new highs here in the last couple of months. So there are parts of the U.S. economy that are seeing a strong V-shaped recovery. One, of course, is e-commerce as it relates to retail sales there, and the housing sector. And the other thing we want to talk about was our portfolios and how investing is like a marathon. What we see a lot of the times is, so this is a chart of a company that we own, had a strong upward move, and then we entered a period of consolidation. And that often happens with best of breed companies. You get a strong period of growth as more and more growth is priced into the stock. Then you have to let it breathe. You have to let it consolidate so that the stock price absorbs the valuation that's now been built into that price. In other words, a stock that was trading at 10 times is now trading at 20 times, needs a period of time to consolidate so it kind of goes back towards 16, 17 times so that it can continue to reprice higher from a stock price perspective. Fortunately, after a few weeks of consolidation here, a lot of our stocks, and we've noticed this as we've gone through the charts, have started to break out again after a month-long period of consolidation. So for our investors, whether it's new investors or existing investors that are looking to put either more money into the market or their portfolios, or new clients that are looking to establish a relationship with us, now is a fantastic time in our opinion. So overall, cheap liquidity, poor investor sentiment, and negative positioning remain an asset if you're long stocks right now. Don't get distracted with economic noise. Election fears do appear to be priced in based on volatility pricing on the futures curve. We're going to continue to monitor this as well as other risks that we may or may not see coming. And then lastly, corporate credit risk premiums are continuing to fall, and that's a good thing in terms of creating a durable long-term environment for asset prices. So overall, thank you for your business. None of this success could be possible without our advisors and their clients, and we're just so thankful and grateful for all your business. If you have any questions, don't hesitate to call in. My phone number is 858-354-5114. Thank you and have a fantastic week.